Welcome back to the Deep Dive. Our mission today is pretty laser focused. We are diving deep into the Q3 2025 earnings call for Upland Software, that's ticker UPLD.
Yep.
And the core tension here, the thing we really have to dissect, is simple, but honestly a bit frustrating. Why did the market dump this stock after the company delivered what looks like a spectacular adjusted profit beat?
That really is the narrative tension. It's the whole reason for this deep dive. You, the investor, are looking at a classic turnaround trade-off.
Okay.
You've got this massive adjusted EPS beat on one hand, a real success story in margin expansion. But that's sitting right next to this continued, expected top-line revenue contraction.
So we have to figure out if this is a sustainable transformation or if they're just, managing a decline really, really well.
Exactly. Is this a healthy, smaller company emerging, or is it just a shrinking business with good discipline?
Okay, let's unpack that right away, because this isn't just some generic cost cutting. This feels like a very deliberate, very strategic pivot.
Oh, it is. They are actively getting rid of the old model, that diversified software roll-up strategy that Upland was known for years.
Right.
Their focus now is, it's entirely on building a streamlined, highly profitable, AI-driven platform. And it's all centered around what they call knowledge and content management, or KCM.
And that's these like customer support databases, enterprise search, that kind of stuff.
Precisely. And that KCM segment, that's the core business now. It's roughly 75% of their revenue. The goal is to run a smaller business, but one that's vastly more profitable and focused. And these Q3 numbers, they absolutely show that plan in action.
So let's hit the numbers that really define this whole contrast. The headline revenue is where people get nervous.
Mm-hmm.
But the profit figure is where management is taken to victory lap.
So total revenue came in at $50.5 million. Now, that was a small beat versus consensus, which was around $49.9 million.
Okay, so a slight beat.
A slight beat. But if you look year over year, it's a steep 24% decline. But, and this is the key, Point Management was very clear that this drop was almost entirely because of the divestitures. They sold off those non-core assets we just talked about, so the decline was by design.
That's a bad optic, that 24% drop.
Yeah.
But this is where the story gets really interesting, because it seems to validate the entire pivot. Just look at the profitability.
The contrast is it's dramatic. The GAAP net loss, which includes all the one-time restructuring charges and things, was negative 9 cents per share, roughly in line.
Okay, expected.
But the non-GAAP, or adjusted EPS, was a massive positive 30 cents.
And just to clarify for everyone, that adjusted number is what management sees as the health of the core business they actually intend to run without all the noise.
Exactly. And compared to the street consensus of 17 cents, that 30-cent figure is a beat of 13 cents.
So they beat profit expectations by a staggering 73%.
73%.
How does a company even do that without just starving the business? It suggests the cost management must have been flawless.
It was. The margin story is the turnaround story. Management kept stressing that the quality of the revenue they kept is far more important than the quantity they shed.
Let's start with gross margin then. That's the most direct indicator of getting rid of those bad assets.
Gross margin jumped dramatically. It's around 77% now, up from about 70% just a year ago.
Why?
That 77% figure is pure validation. It shows the KCM platforms they kept are just inherently higher margin businesses.
And that discipline, I assume, flowed right down to the adjusted EBITDA margin.
Absolutely. Adjusted EBITDA hit $16.0 million. That gives you an eye-popping 32% margin.
32%. That's up from what, 21% last year?
Yep, up from 21. And what's really fascinating here is that management's long-term goal for their operating model is a 32% margin. They basically hit their multi-year target in Q3.
Years ahead of schedule.
Mm-hmm.
But okay, here's the skeptical question. A 32% margin is huge, but is it sustainable? Or did they just slash R&D for a quarter to hit a nice headline number?
And that is the exact debate the market is having right now.
Okay.
But management was proactive on this. They said the improvements were structural-like, retiring old data centers, consolidating functions, not just temporary cuts.
But the market needs proof. They need proof that they can actually grow without falling right back below that 30% threshold. And that proof hinges on one single metric:
core organic growth.
So where's the evidence of that?
This is the major green shoot they were pointing to. Management called out positive 3% core organic growth in Q3.
After years of being flat or negative.
Exactly. Think about the trajectory. They were at negative 2% in 2023, then negative 1% in 2024. Hitting plus 3% in one quarter is a critical inflection point. It suggests the bleeding has stopped.
So if Q3 was 3%, what's the full year target looking like?
They're targeting about plus 1% for the full year 2025. But the forward targets are where it gets really interesting. They're aiming for a sustained 3% in 2026 and then 5% plus after that.
That's ambitious.
It is. The whole turnaround story depends on stacking these new large AI deals on top of their stable base to hit those numbers.
Okay, before we get to the AI deals themselves, we have to talk about the balance sheet. They've been de-risking like crazy to buy themselves time.
Absolutely. They generated $6.7 million in free cash flow in Q3 alone.
And they're targeting around $20 million for the full year.
Right, with a plan to get that to about $22 million in 2026. This cash flow is the engine that's letting them pay down debt.
Think about that. They paid off $242 million of debt since early 2024. They took a chainsaw to their debt load. That gives them breathing room.
And critically, they refinanced their remaining term debt.
Yeah.
They pushed the maturity out 6 full years.
6 years to win.
To July 2031. This just dramatically de-risks the business. The near-term liquidity crunch is gone.
Okay, so the balance sheet is stable. Now let's pivot to the growth engine, AI. This is what's supposed to drive those future targets. What green shoots did they actually show us?
They pointed to 2 major multi-million-dollar deals in Q3. The first was a $2 million multi-year deal with a Fortune 100 tech company.
A Fortune 100 company is a huge validator. What are they using Upland for?
They're using Upland's Right Answers product as the knowledge base for an internal generative AI answer engine.
So Upland is the plumbing.
Exactly. It's the essential sticky plumbing for this tech giant's whole AI self-service strategy. That's a great position to be in.
Okay, that suggests the tech is core infrastructure, not some legacy product. What was the other big win?
A $1 million multi-year deal with a global pharmaceutical company. They're using the BA Insight platform, also powered by AWS Bedrock, to replace a legacy search system.
So again, modernizing a crucial function.
Yes. And these are exactly the kind of 6- and 7-figure deals they need to keep landing to hit those growth goals for 2026 and beyond.
And this all ties into their strategy with the big cloud providers, like AWS.
It's crucial. Having their products in the AWS marketplace just simplifies everything for big enterprise customers. It makes it easier to buy, easier to get budget for, and being featured in the new AI agents and tools category is a huge stamp of approval.
Okay, so let's take stock here. Massive margin execution, aggressive de-risking on the debt, and a critical inflection to 3% core organic growth, backed by 2 big AI deals.
Yep.
If all of that is true, why on earth did the stock fall over 10% after the announcement? This is the disconnect we have to solve.
This is all about market psychology. I think investors have a form of turnaround PTSD.
Huh? I like that.
They're just fixated on that ugly headline revenue number, that negative 24%, and they aren't looking at the quality of what's left.
So they're projecting past failures onto the current success.
I think so. And the market fixated on this tiny little guidance trim. Management reduced the full year revenue and EBITDA midpoints by less than $1 million.
And why do they do that?
They cited reduced perpetual license revenue, which is a non-core, non-recurring item. It's not part of the strategy.
Wait. They trimmed guidance by less than $1 million on a non-strategic item, and the market wiped out tens of millions in value.
Yes, because in a turnaround story, any guidance trim, no matter how small, just spooks investors. It hints at execution risk.
So the market is just saying, show me.
Exactly. They're saying 1/4 of 3% growth is a nice green shoot, but it's not a trend yet. Show us you can do it again in Q4 and then in Q1 of next year.
And the valuation context here is key. The stock is trading near its 52-week low with a tiny market cap of, what, $50 to $55 million?
It's tiny. And the irony is you look at analyst ratings and it's a strong buy with a $4.50 price target. The potential is there, but the market is just sitting on its hands waiting for more proof.
Which brings us, to our favorite segment, where we take all this data and spin up an outrageous but plausible trade idea.
Right. And of course, a reminder to everyone, this is purely for entertainment, for speculation. This is not financial advice.
Definitely not. Okay, lay it on us.
So I'm calling this the private equity takeout thesis.
Ooh, okay. I like it.
The thesis is simple. The public market is valuing Upland like it's a shrinking, low-quality legacy asset.
Right. They see the headline revenue drop and they run for the hills.
But if you actually look under the hood, after the restructuring, it's operating like a highly profitable, very stable, niche AI infrastructure asset.
So what's the math that supports that?
The valuation is it's absurdly low compared to its cash flow. You have a $50 million market cap on a company targeting $20 million in free cash flow next year.
So it's trading at 2.5 times its annual cash flow.
That's not a valuation, that's a fire sale. That's exactly the kind of math that financial buyers, private equity, they live for that.
So the idea is to go long betting on a potential strategic takeout, and the buyer would be PE.
Almost certainly. A sophisticated financial buyer would look at this and see a stable, high-margin subscription base, 30+% EBITDA margins, and that predictable $20 million in cash flow. And the hard part is already done.
The restructuring.
The restructuring, the debt is long dated to 2031. It's an easy asset to acquire and just let it print cash. It's instantly accretive for almost any fund.
Yeah. And the risk. Where does this beautiful thesis fall apart?
It fails if they can't hit that 3% core organic growth target in 2026. If growth stalls out again, the market will realize the only lever left is more cost cutting, and that erodes the whole story.
So to wrap this whole deep dive up, Upland showed outstanding execution on margins and the balance sheet. They hit that critical green shoot of positive core organic growth, powered by some really impressive AI deals.
They've absolutely delivered on profitability and stability. The evidence suggests they are successfully changing the story from a shrinking roll-up to a profitable AI-enabled infrastructure asset.
So the ultimate question for you, the listener, is this. Does 1/4 of 3% core growth, backed by 2 big AI deals with a partner like AWS, justify believing management's multi-year growth targets?
Or will the market, having been burned before, need another 2 or 3 quarters of consistent proof before it's willing to re-rate the stock out of its 52-week lows?
The debt runway is massive. They have until 2031. But the market is demanding they use that runway now to invest in growth, not just sit on it.
So the question for management is, can they shift from that cost-cutter mindset to a growth spender mindset without tanking the margins they just worked so hard to build? What stands out to you as the clearest sign this turnaround is actually sustainable?
That is the thought we leave you with today. Thanks for joining the deep dive. We'll catch you on the next call.